As of the market close on Friday, November 21st, 2025, AMC Entertainment Holdings, Inc. is trading at exactly $2.20 per share. The stock finished the last trading session up approximately 5.1%, reacting sharply to macroeconomic signals rather than company-specific news. While the market is currently closed for the weekend, this closing figure sets the stage for a highly volatile opening on Monday. Most retail investors looking at this price point immediately assume one of two binary outcomes. Either the stock is destined for zero due to its debt load, or it is coiled for another massive short squeeze reminiscent of 2021. The expectation is that AMC trades purely on meme energy and social sentiment. The reality, however, is far more mechanical and tied to the bond market. What we are witnessing right now is not just a battle between apes and hedge funds, but a complex credit arbitrage play, where equity value is explicitly tethered to the Federal Reserve's interest rate policy. The 5% jump on Friday wasn't because more people decided to see movies. It was because New York Fed President John Williams hinted at further rate adjustments, instantly making AMC's variable rate debt slightly less toxic. This is the nuance that separates casual observers from serious analysts using platforms like interactive brokers or Fidelity wealth management tools to track credit spreads. Let's examine the immediate market action we just saw. Friday's move was significant because it decoupled AMC from some of its usual trading baskets. Typically, when you see high beta stocks like Tesla stock or Nvidia stock rally, AMC follows suit simply due to algorithmic correlation in risk-on environments. However, the recent price action suggests a specific sensitivity to the cost of capital. With a market capitalization hovering around $1.13 billion, AMC is effectively priced as an option on its own survival. The volume on Friday spiked to over 26 million shares, well above its average, indicating that institutional algorithms were likely adjusting their risk models based on the new Fed commentary. For individual traders using Robinhood stock trading or the SoFi trading platform, this volume spike is a critical signal. It suggests that liquidity is returning to the name after a period of dormancy. When volume dries up, a stock like AMC becomes vulnerable to manipulation or slow bleeding. But when volume expands on up days, it confirms that there is still a bid waiting at these lower levels. The tension between the dead mall narrative and the turnaround thesis is where the opportunity lies. Most bearish analysis focuses on the diluted share count, which now exceeds 512 million shares. They argue that the equity is diluted beyond repair. However, the contrary view, the reality that keeps the price resilient above $2, is that the company has successfully extended its debt runways. Investors utilizing Fidelity Investments or Schwab Intelligent Portfolios often avoid these types of distressed equities because they don't fit standard value criteria. Yet for the active trader on Robinhood Crypto or SoFi active investing, the volatility here is the asset itself. The stock doesn't need to go to $100 to be profitable. It just needs to fluctuate between $2 and $3 to offer massive percentage gains for swing traders. This is why we see such heavy discussion on investing sites and forums about loading zones. The market expects the dilution to kill the momentum, but the reality is that the dilution provided the cash pile necessary to survive the strike-impacted slate of films in 2024. We must address the mechanics of how this stock is traded today compared to 3 years ago. In the past, it was about sticking it to the shorts. Today, it is about market structure. If you look at the flow data from Interactive Brokers stock trading platforms, you see a shift from pure buy and hold to complex options strategies. Retail investors are increasingly using Robinhood fractional shares and Fidelity IRAs to gain exposure, but the smart money is selling volatility. They are writing calls against their holdings to harvest premiums. This creates a ceiling on the stock price, but also a floor. When the stock dips below $2.05, put selling increases, effectively acting as a soft support. When it rips toward $2.50, call selling intensifies. This range-bound behavior is frustrating for those expecting a moon event, but it is a paradise for range traders using fidelity trading platform tools or interactive brokers fees structures that favor high-volume, low-margin scalping. Macroeconomics are currently the primary driver for AMC. The company is carrying a massive debt load, much of which is sensitive to interest rates. When the Fed signals a higher-than-longer stance, AMC suffers because its interest expenses eat up all its operating cash flow. However, the moment the narrative shifts, as it did on Friday with the Williams comments, stocks like AMC are the first to react. It acts like a levered bond. If you are managing your own money through self-investing or using online investment tools, you need to understand this correlation. You cannot trade AMC in a vacuum. You have to watch the 10-year Treasury yield. If yields drop, AMC rises. It is almost that simple in the short term. This is why users on SoFi Invest and Robinhood cash management accounts need to pay more attention to the bond market than the box office numbers on opening weekend. The box office matters for the long-term survival, but the bond market dictates the price action for the next 6 months. Let's pivot to the fundamental business performance, which serves as the backdrop for this financial engineering. The box office recovery has been uneven. We are currently looking at the holiday slate for late 2025, with major releases like Wicked Part 2 and Avatar 3 on the horizon. The expectation from the street is that cinema is a dying industry, permanently maimed by streaming. The reality, which we see in the data, is that while volume of films is down, revenue per patron is up. People are spending more on concessions than ever before. If you look at the earnings reports accessible via Fidelity Mutual Funds research or Interactive Brokers platform news feeds, you will see that AMC's food and beverage revenue per patron hits record highs consistently. They have optimized the extraction of value from every customer who walks through the door. The problem isn't the popcorn, it's the number of movies. The strikes in 2023 and 2024 created a content gap that is only now being filled. Comment below how many shares of AMC you currently hold and what your average cost basis is. Are you still holding from the 2021 highs, or did you enter during this recent consolidation? Critically, we have to talk about the competition and the sector. While Apple and Amazon Prime Video are investing billions into theatrical releases, they are doing so to funnel users to their ecosystems. AMC is the beneficiary of this war. They are the neutral ground where these streamers fight for cultural relevance. A movie released on a phone screen doesn't have a cultural moment. A movie released in 10,000 theaters does. This is the intangible asset that isn't on the balance sheet. Investors utilizing investment help services or SoFi robo-advisor algorithms often miss this qualitative factor. The moat around AMC isn't its technology, it's its physical footprint. You cannot replicate 10,000 screens overnight. This infrastructure value is why some deep value investors, the types who usually stick to Fidelity FTFs, are keeping a close watch on the stock. If the company can restructure its debt again, the equity slice could re-rate significantly higher. However, we must remain objective about the risks. The reduced consensus rating from analysts isn't just hatred, it's math. The company has a negative shareholder equity in tangible terms. If they were to liquidate today, common shareholders would likely get nothing. This is the grim reality that balances the hype. When you use Invest Online tools to look at the balance sheet, the liabilities section is daunting. They have high-interest notes coming due in 2026. This maturity wall is the single biggest threat to the stock. If the credit markets freeze up, AMC cannot refinance. If they cannot refinance, they default. This binary risk is why the stock trades at $2.20 and not $20. Every investor using Robinhood Investments or Fidelity mobile app needs to know that they are effectively playing a game of chicken with the corporate bond market. The institutional ownership profile is also telling. We see heavy hitters like Vanguard and BlackRock holding distinct positions, largely to support their passive index funds. But we also see increased activity from quantitative hedge funds. These entities don't care about the movies, they care about the spread. They're using Interactive Brokers' stock trading algorithms to arbitrage the difference between the convertible bonds and the common stock. This creates immense selling pressure whenever the stock rallies. If AMC pops 10%, these funds short the stock to lock in the value of their convertible notes. This mechanical selling is why rallies often feel capped or suppressed. It's not necessarily a conspiracy, it's just the mechanics of convertible arbitrage. Retail investors on Robinhood app often misinterpret this as crime, but it is actually just standard Wall Street hedging. Looking toward the future, the outlook for 2020